Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. So for today, we've got, of course, 5 questions. Number 1, we're going to look at what are the best financial tools for retirees. Number 2, how do HSA, health savings account receipts, work, particularly if the balance in your HSA exceeds the value of all of the receipts you've been saving. Question 3, how do dividends work in terms of calculating your withdrawal rate each year in retirement? Number 4, when we retire, should we make any big changes to our portfolio beyond perhaps the stock bond allocation? Should we think differently about how we invest? For example, should we become income investors, where we're trying to get investments that generate income? And then finally, a very interesting question. There's some YouTube videos out there of Warren Buffett at the Berkshire Hathaway annual meeting from several years ago, basically saying bonds are a terrible investment. So folks have asked me about that. So that's what we're going to cover. If you'd like to send in a question, you can subscribe to the newsletter. It's free. It goes out every Sunday morning. You can find the link to it below this video, and then just hit reply. I get thousands of emails. I do my best to read them all. But that's where these questions come from. So that's how you can submit a question for a future 5 Question Friday video. Okay, so with that, let me dive into the actual questions. This first one comes from Bill. He says, I especially like to see and understand what tools others are using. But then he adds, but given I'm already retired at 68, I'm conflicted on which tool from your list you're recommending. Is there one that's recommended for those of us in retirement, or should I really consider multiple tools? It's a great question. And for me, the starting point is, what do you want the financial tool to do for you? And by and large, I think of it in 3 different buckets. So one is a budgeting tool, which you may or may not want. One is a tool to track your investments, your performance, your asset allocation. And then a third potential tool is retirement planning, to actually plan out your retirement, make sure you've got a good plan in place, you're not spending too much money, and you want to avoid the risk, of course, of running out of money in retirement. But you also may want to avoid spending too little. You want to enjoy your retirement. So those are basically the 3 sort of categories of tools, at least that I think about. And frankly, they apply to everyone, whether you're in retirement or not. I don't know that being in retirement changes necessarily the tools that you're going to use. It may change how you use it. And but for each of those categories, I can show you a few things. And we'll come back to Mr. Buffett in a minute. We'll start with this tab. So this is just one of the pages on my site that lists, in this case, budgeting apps. I mentioned some favorites. The truth is, so I use Monarch Money, but the truth is just about any app on this page, and I really need to probably add a few more to this page, are really good apps. A lot of it comes down to personal preference. I suppose it might come down to cost, although they're all, I think relatively inexpensive. So a lot of times it just comes down to preference. Most of them have free trials, so you could try them for free. And if you liked it, stick with it. So this would be for budgeting. Again, I don't know that I would recommend one over another just because you happen to be retired. If you want to actually plan out your budget going forward, most of these apps, probably the only one that can't do a forward-looking budget would be Empower. And we'll come back to Empower in a minute, but it's listed here. It's more of a cash flow tracking. It shows you how you spent your money, but doesn't really allow you to budget going forward. I think all of the other tools do, but you could use any one of these for budgeting, and I think they're really good. Now, in terms of planning for retirement, my 2 favorites I think at the moment are Boldin. This is a demo account, but this is just sort of what it looks like. We've covered it on the show many times. And my second is Projection Lab. I think this is a great tool as well. I can actually offer you a 10% discount with a promo code for Projection Lab, but to get it, you need to sign up for my newsletter. You'll get an automatic email with the promo code. I'm doing that not to try to build up my email list. You can unsubscribe if you want, but the founder of Projection Lab just asked me to do it that way, and I agreed to do that. So I think both of these are good. There are certainly other tools out there, and I have a page on retirement planners. I'll link to it below the video, along with the page on budgeting, that would include things like Prelana, I think is a good one. Harder to learn, but probably gives you more features, maybe more than what you want, or it may be exactly what you want. But there are others. Maxify is another one. But I think for me, Boldin and Projection Lab are probably the two that I would view as probably ideal for the vast majority of people. Now, it gets us now to investment tracking. And here there are a number of tools. The one that I think a lot of people use is Empower. Again, this is a demo account. The thing about Empower, and this is to Bill's question, you could really use this for all three, for budgeting, for tracking your investments, and retirement planning. As I mentioned, from the budgeting perspective, it will track your expenses. I have not linked many accounts to it, but you'll see some expenses here. So it will track your expenses, but it won't let you do a forward-looking budget. So that's, I guess just depends on whether you want that or not. But it also has a retirement planner. It's not as detailed as Boldin or Projection Lab or Prelana, but it's really good. You can create multiple scenarios and compare them. You can enter expenses, income, Social Security. So it's a pretty robust retirement planner, and it's free. And then, of course, you can track your investments. And we'll just go to asset allocation as an example. It shows you can track your fees, your asset allocation. So if you wanted one app, this would be probably the only one really that does what it does. But in terms of tracking your investments, the only other thing I would mention is this free spreadsheet. We've talked about it in the past. It's a Google Sheet spreadsheet. It takes a little bit of time to set up your accounts. I'll link to where you can find it below the video, but it's free. It won't update your share balances automatically. So you'd have to go in, once a month or once a quarter, update your share balances, but it will update the prices of your investments, at least to the extent that they're publicly traded. Occasionally, some investments like money market funds won't get updated automatically, but they always, or most of the time, are priced at $1 a share, so that's not too hard. But you would have to update the share count. So kind of run through those quickly. I'll leave a lot of links below the video, but I think all of those are good options, and great question. Okay, number 2, this has to do with HSA receipts. So this one comes, I think, from Nick. Yes, from a viewer named Nick. What is the significance of keeping the medical/pharmacy receipts? My understanding is that receipts are required for the tax return of the year the HSA funds are used. So in other words, when you pull the money out of the HSA, which will be later in retirement for us. So in other words, they're just paying their medical expenses, let's say, out of a checking account. They're saving their receipts. And then at some point in the future, they'll pull the money out of the HSA. And if they ever get audited, they can say to the IRS, no, here are all our receipts for our qualified medical expenses. And that's what they would do. But then Nick goes on. This is where it gets cloudy. What if the account increases, the HSA account increases in value many years into the future, and the value of the HSA exceeds the dollar value of the receipts? Well, it's a great question. And it kind of raises an important point. We need to think about the balance of our HSA, particularly as it grows. Will we have enough medical expenses to use, hopefully all of it, or at least most of it? Keep in mind, you don't have to rely just on receipts in the past. As long as we're still alive and we still have medical expenses, we can continue to use the HSA for current medical expenses as well. So our sort of plan at the moment is we will start tapping into our HSA when we reach the age of Medicare. That's somewhat of an arbitrary decision, but although we won't be able to contribute to it after that. You can't contribute to an HSA when you're on Medicare. There might be some exceptions to that I'm not aware of, but generally that's the case. So it kind of made sense for me to just sort of in my mind pick that time period. And we very well might not have, if we add up all the receipts, and we've been saving them, they may fall short of our HSA balance. And that's okay, because you can use it to pay for certain expenses as just as you incur them, as long as they're qualified medical expenses. And so we'll just continue to use it. Now, after you're 65, not 59 and a half, but 65, you can pull HSA funds out for any reason without a penalty, but you would pay taxes on it. And HSAs are not great accounts for non-spouses to inherit, because they just basically have to pull the money out and pay the taxes on it. If a spouse dies, the living spouse can sort of fold the deceased's HSA account into his or hers, not unlike how a spouse might inherit an IRA, for example. So some other rules to sort of think about. But yeah, it can be an issue. You could be in a situation where potentially you should stop contributing to an HSA. But the analysis of that, it's not perfect. You're sort of making your best guesses about your future medical needs and expenses. And as we all know, that's not easy to do. You just have to do the best you can. But yeah, that's my take on a great question. All right, number 3. This has to do with creating sort of a monthly paycheck in retirement. So this comes from a viewer named Kathy, and she says that she's managing her money for her 85-year-old mom. And she says, as we start 2026, which is just around the corner, I want to pull out the cash she will need and set it up into an automatic monthly paycheck. My question is, how should I think about dividends as part of her withdrawal strategy? For example, if she has $1 million and I sell 5% of her portfolio in January to fund her money market account, plus I also have dividends that she earns that year going into her money market, am I withdrawing more than 5%? Or am I just changing her asset allocation? Or am I just overthinking it? No, it's a great question. And this is where we have to be careful with dividends. So ignore the dividends for a moment. You've got $1 million. Whatever you pull out of that account to spend counts towards the percentage you're spending this year. If some of it gets paid in a dividend and then you pull it out, okay, you've just pulled out, let's just say $10,000. And if you've then sold $50,000 of the million, actually sold the shares and pulled that out too, well, you've pulled out a total of $60,000. $50,000 from selling shares, $10,000 from dividends that were earned in the account, for a total of $60,000 on a $1 million portfolio. That's 6%. So the short answer is, yeah, every dollar you pull out counts, whether you pulled out a dollar that was paid to you, or in this case, your mom, in the form of a dividend, or you sold a share to pull it out. And this is where we don't want to get too hung up on the dividend part of it. Where the dividends matter, in my view, are in taxable accounts, because when you get paid a dividend, it's considered taxable income, right? Whether you spend it or not. So in my mind, I always want to pull the dividends out first, at least from a taxable account, and spend those first, because I'm going to get taxed on them anyway. And then if I need more money on top of that, that's when I can sell shares, whether it's selling shares in a taxable account, or I might choose to pull money from a traditional IRA or a Roth IRA, just depending on how I want to manage my tax liability for the year. But the short answer to the question is yes, dividends count too. And so if you sell 5% of the investments and pull that money out, plus you pull out the dividends, yeah, you're pulling out more than 5%. Now, your mom's 85, and so pulling out more than 5% might be okay, right? That might, from a retirement planning perspective, that might certainly be reasonable. Of course, we would need to know a lot more than I know from this email to talk about that, but I just mentioned that as well. So great question. Okay, number 4. This comes from a viewer named, I've lost their name. I guess I don't know their name. Oh, they didn't give me their name. Prop Search, that's their name. Okay, I'm just months away from retirement and need advice getting my portfolio in order. I have been primarily in a 401k and mostly in an S&P 500 index fund. And the question is, do I change that? Or, do I change that now as I'm going to retire and just worry about income? So this is where, I don't know if my view on this is a minority view. I guess I'll let you guys decide that. But you'll hear a lot of talk, in articles, books, other YouTube videos about retirees needing to create some sort of retirement paycheck by making investments that generate a lot of income. And so you'll find folks investing in very high yield ETFs that could be covered call option ETFs, put a lot more than they had while they were working into, say, REITs or high yield bond funds that generate a lot of yield. I don't believe that's necessary, and I often think it's really not the best idea. This is where I believe that there's really no difference between getting money through a dividend or interest and just selling shares. At the end of the day, if you've got $1 million in your IRA and you need to take out 40,000, you take out 40,000. In fact, in an IRA where we don't worry about taxes until we pull the money out, we don't even really think about, should I pull out a dividend? That doesn't really make sense. $1 is $1. You've got $1 million in there. If you take out 40,000, you'll have 960,000 left in there. It doesn't matter if the 40,000 came to the account via a dividend or just market increases, right? That doesn't really matter. Now, in a taxable account, it matters, but again, it matters, in my view, just because of the taxes and how dividends are taxed. And so you'd want to start with the dividends. You'd think of those separately. But again, only from a tax perspective, in my view. Now, I would certainly invest in something broader than just the S&P 500 index. I like to have a broader U.S. market fund. I want to have international stocks at a minimum in the equity portion of the portfolio. I do think some fixed income is important, generally all the time, but certainly in retirement. But in terms of, do you need to change the portfolio in some way so that it generates a lot more in dividends and a lot more in interest than it did during your working years? And my view of that is no. And in fact, when you look at almost all of the papers that deal with safe withdrawal rates, the 4% rule, guardrails, all these sort of retirement spending strategies, I don't know that I can even think of one that said, well, wait a minute, we got to think about dividends and income differently. No, they just look at total return, which includes dividends and interest and changes in the value of the underlying shares. They don't separate it out between dividends and interest on the one hand and increases in the value of the underlying, say, shares on the other. They just look at total return, because that's ultimately what's going to drive the success or failure of a retirement spending plan. So that's my take. Might be a minority view. I don't know. Does it really matter? I guess not. All right, fifth and final question. And I'll just sort of summarize it, but I'll read it. It says, and this comes from Karen, I believe. Yes, Karen. I've been watching several YouTube videos of Warren Buffett speaking at his Berkshire Hathaway meetings. He's very concerned about people having money in cash, bonds, and bond funds. He believes strongly that our best bet is to keep everything in the S&P 500 stock fund. He seems to go against everything I've been told to do. Diversify. Have you seen any of the videos? And if so, what are your thoughts? Well, the one video I'll show you is this one, and I'll link to it below the video. This is from 6 years ago. Obviously, this is at the Berkshire Hathaway meeting when Mr. Munger was still with us. And basically, what he says in this video is that long U.S. Treasuries, so think 30-year Treasury bonds, are a really bad investment. But then he adds, at current yields, right? Now, this was 6 years ago. I don't know that his opinion has changed any. The yields have come up a bit since then. But yeah, his view was these were really bad investments. But I should stress that I wouldn't go so far as to say cash bonds and bond funds. At least in this video, he was talking about 30-year Treasury bonds. In the same video, he mentions that Berkshire has a lot of money invested in T-bills. At that time, he said they were primarily 4-month maturity T-bills, which they're certainly bonds, right? They're a type of bond. I think many people, myself included, might lump them with cash because it's such a short-term bond, 4 months, and of course you can get T-bills that are even shorter than that. So, and of course we know now that Berkshire has hundreds of billions of dollars in T-bills right now. But I think there's sort of a bigger picture here. Warren Buffett is investing differently than you and I are going to invest in a couple of ways. First of all, he's investing hundreds of billions of dollars on behalf of Berkshire Hathaway. He's not trying to manage a retirement portfolio like you and I might have that we're spending out of, and we need to take some comfort. That's the first thing. The second thing is, at times, like now, he has a truckload of capital in fixed income. I mean, it's grown and grown. Now, he's probably waiting for the opportunity to make what he thinks are really good investments, and at the moment, he just hasn't found any. And so he's just letting that cash sit there. But I wouldn't go so far as to say he thinks you shouldn't have cash in bonds. And in fact, sometime, I think a few years before that, he mentioned what he viewed as a really solid portfolio, 90% S&P 500, 10% Treasury bills. So at least in that case, he was recommending 10% cash or bonds. Now again, though, he wasn't specifically asked, okay, we've got someone who's 65, they're retiring, they're nervous about the stock market, how should they invest? He wasn't answering that question. In our case, I think fixed income is an important part of a retiree's portfolio. You will find out there some that argue, including, by the way, Dave Ramsey, that you should have 100% in stocks during your retirement years. I've listened to many of those arguments. I haven't found any of them persuasive. I've done other videos on them in the past. I won't rehash all of that. But the reality is, I think most retirees probably can't stomach a 100% stock portfolio. And if we ever encountered something similar to, let's say, the 1929 stock market crash that then ushered in the Great Depression, I think we would find a 100% stock portfolio would absolutely crush our retirement. Now, you might say, what are the odds of that happening? Not great. I get it. But it just seems to me a risk that retirees just don't have to take. Now, I will just add one other thing. Most retirees have Social Security, and many have a pension. You may have some other forms of guaranteed income. And for some, if all of that guaranteed income is enough to meet your needs, and that your retirement savings is more for that extra spending you want to do, maybe also for legacy to give to your children or to charities, it might make sense to invest that predominantly in stocks. But that's because you don't need it to live on. You can live entirely off let's say, your Social Security and a pension. I say that to stress that every situation is different, and we have to look what I'll say beyond the portfolio. We can't just focus just on the portfolio and make a decision about how we should invest it. We have to look beyond the portfolio at things like other forms of income, guaranteed income, what's our debt, what's our flexibility for spending, can we reduce our spending if we have to. So we have to look beyond the portfolio to decide how that portfolio should be invested. But for most people, I think fixed income is pretty important. And at the end of the day, if I kind of then disagree with Mr. Buffett, which I don't really think is the case, but if it is, so be it. It's probably not a good place to be, disagreeing with him on how to invest, but there you go. So that's my take on the question. I'm actually going to have another video that talks about that very issue and thinking about how to invest your portfolio when you have other sources of guaranteed income. That'll come out actually in the next few days. So hopefully this has been helpful. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.